morning everyone. Today our group will be presenting on accounting challenges of digital assets and cryptocurrency. Digital assets are assets that exist in electronic form and derive value through digital technology. One of the most common categories of digital assets is cryptocurrency, such as Bitcoin and Ethereum. Unlike traditional currencies, cryptocurrencies operate on blockchain technology and are secured using cryptography without relying on a central authority. In recent years, cryptocurrencies have become increasingly important as more businesses invest in them, accept them as payment, or hold them as part of their investment portfolios. As their adoption grows, accountants are required to determine how these assets should be recognized, measured, and disclosed in financial statements. However, the rapid development of digital assets has created significant challenges because existing accounting standards were developed before cryptocurrencies became widely used. This has raised questions about whether the current IFRS and MFRS framework remains suitable for accounting for these new forms of assets. True is that there is currently no dedicated IFRS or MFRS accounting standard specifically for cryptocurrencies. In 2019, the IFRS Interpretation Committee concluded that cryptocurrencies generally do not meet the definition of cash because they are not legal tender issued by government. They are also not considered financial instruments because holding cryptocurrencies does not create a contractual right to receive cash or another financial asset. As a result, companies usually account for cryptocurrencies using IAS 38 intangible assets. If cryptocurrencies are held for sales in the ordinary course of business by broker traders, IAS 2 inventories may apply instead. While this provides temporary guidance, IAS 38 was originally designed for assets such as patents, trademarks, and software rather than highly volatile digital assets. Consequently, many researchers argue that applying IAS 38 to cryptocurrencies does not always provide the most relevant or comparable financial information. Traditional accounting standards struggle because cryptocurrency possess characteristics that differ significantly from conventional assets. First, cryptocurrency prices are highly volatile. Under IAS 38, many entities apply the cost model, meaning increases in market value may not be recognized immediately, reducing the relevance of financial statements. Second, because there is no dedicated accounting standards, companies have historically adopted different accounting policies for similar cryptocurrency holdings. This reduces consistency and makes comparison between companies more difficult for investors. Third, current accounting standards provide limited guidance on disclosure, valuation, impairment, and presentation. These reporting inconsistencies increase uncertainty for investors, auditors, and regulators.
We have just established that the core issue is an accounting timeline mismatch. We are essentially using rules from 2001 to report on technology like Bitcoin that didn't exist until 2009. This is not just an academic debate. This regulatory vacuum creates a multi-layer impact that changes the financial landscape for business, investor, and the entire global economy. Because there is no specific standard, companies are forced to choose their own optics, leading to reporting that is often inconsistent and misleading. Okay, first, let's look at the distortion of business profitability. According to Law NU 2024, US GAAP requires firms to treat Bitcoin as an indefinite-lived intangible asset. This creates a severe impairment bias. Companies must record a loss if the price drops even for one day, but they are strictly prohibited from recognizing any upward revisions if the price recovers. The data provides clear evidence. In 2021, Tesla recorded a 27 million impairment loss. Similarly, in 2020, MicroStrategy recorded massive 71 million impairment because the Bitcoin can drop by 40% in a single day. These book values often reflect the lowest price since acquisition. Consequently, these companies appear significantly less profitable than they truly are, which undermines the value relevance of their financial reports. Second, this issue creates a reporting paradox for investors. Our research highlights a critical example, the mining giant Bitmain. In 2018, Bitmain reported a massive 742 million profit, yet their operating cash flow actually showed a negative 621 million. Why the distortion? Because this classified $516 million from crypto to fiat conversion as an investing inflow rather than an operating one. This masks the core business true cash-generating ability from investor. Furthermore, as noted by Low and You 2024, firms often place these highly liquid assets in the long-term sections of the balance sheet. If these assets are omitted from liquidity ratios by data aggregators like Compustat, investors receive an inaccurate picture of the company's immediate financial health. Okay, finally, the sheer scale of the impact on the global economy cannot be ignored. Clopper and Brink 2023 highlight that the market capitalization of cryptocurrencies exploded from just 30.5 billion in 2016 to staggering 2.5 trillion by late 2021. The number of available assets grew from 660 to over 216,000 in the same period. This exponential growth has forced traditional giants like Grayscale and Renaissance Technologies into the market, creating an urgent need for regulatory frameworks like MiCA in the Europe to protect holders from an otherwise unregulated and highly volatile market. So in summary, the impact is multi-layered. It creates valuation bias for business, distorts financial health for investors, and leaves a $1 trillion economy operating without a dedicated map. This is why we will now explore the specific challenges accountants face in trying to solve these issues.
Next, I will now discuss the key challenges faced by companies and accountants when accounting for cryptocurrency. The first challenge is classification as uncertainty. Unlike traditional assets, cryptocurrencies serve different economic purposes. Some are held as long-term investment, some are actively traded, while others function as payment or utility tokens. Ferrando highlights that crypto assets should be distinguished into payment tokens, utility tokens, security tokens, and e-money tokens because each has different economic characteristics. However, current IFRS does not differentiate these categories clearly for accounting purposes. As a result, companies rely heavily on professional judgment when deciding whether to apply IAS 38 or IAS 2. The real challenge is not simply uncertainty, but that existing accounting categories cannot fully capture the diverse nature of crypto assets. This increases inconsistency and reduces comparability between financial statements. The second challenge is valuation. Cryptocurrency prices are highly volatile and change continuously in active markets. While historical cost provides reliability, it often fails to reflect current economic value. At the same time, fair value may be difficult to determine for less actively traded tokens. Therefore, accountants face the difficult task of balancing relevance with measurement reliability. Besides practical challenges, there are significant weaknesses in the current accounting standards. The first weakness is the absence of a dedicated cryptocurrency accounting standard. Instead of providing direct guidance, IFRS requires companies to apply IAS 38 or IAS 2 by analogy. Luo and Yu found that this flexibility has resulted in different accounting policies among listed companies, reducing consistency and comparability across financial statements. The second weakness is the measurement model. Under IAS 38, Cryptocurrencies are generally measured at historical cost, less impairment. However, impairment losses are recognized immediately, while gains are usually recognized only when the asset is sold. Klopper and Bring argue that this approach does not faithfully represent the economic substance of cryptocurrency because it ignores real-time market value. They conclude that fair value measurement provides more relevant and decision-useful information for investors. The third weakness is insufficient disclosure guidance. Current IFRS standards provide limited direction on reporting valuation methods, custody arrangement, cybersecurity risks, and the purpose of holding crypto assets. Without consistent disclosures, investors may struggle to understand a company's exposure to digital assets and compare it with other companies. These weaknesses reduce the relevance, faithful representation, and comparability of financial information, which are three essential qualitative characteristics in the IASB conceptual framework. When analyzing the three journal articles together, a common conclusion becomes clear. Parando explains why current accounting standards struggle by showing that crypto assets have different economic functions and therefore cannot always be accounted for using a single approach. Luo and Yu then provide empirical evidence that this conceptual gap has already led to inconsistent reporting practices among companies, making financial statements less comparable for investors. Finally, Klopper and Bring argue that the solution is not merely creating new rules, but adopting accounting treatments that better reflect the economic substance of crypto assets. Their analysis supports fair value measurement because it improves relevant and faithful representation, particularly in active cryptocurrency markets. Our group believes these studies collectively show that the core challenge is not simply the absence of a cryptocurrency standard. Rather, existing IFRS standards were developed for traditional assets and are being stretched beyond their original purpose. As cryptocurrency adoption continues to expand, relying on standard by analogy is unlikely to provide consistent, transparent, and decision-useful financial reporting. Therefore, addressing these reporting weaknesses will require both a dedicated accounting standard and a broader evolution of financial reporting to keep pace with digital innovation.
Based on the challenge discussed in the previous section, several recommendations can be implemented to improve cryptocurrency accounting and financial reporting in Malaysia. The first recommendation is for the Malaysian Accounting Standard Board (MASB) to issue clearer guidance on the accounting treatment of cryptocurrency under the existing MFRS framework. At present, companies rely on MFRS 138 Intangible Assets or MFRS 102 Inventories because there is no dedicated accounting standard for cryptocurrency. This has resulted in inconsistent accounting practice across different entities. In the long term, MASB should adopt a dedicated MFRS that is aligned with the future IFRS developments on crypto assets. This standard should classify crypto assets according to their economic substance, such as payment tokens, utility tokens, security tokens, and stablecoins. A clearer classification framework would reduce uncertainty, improve consistency, and enhance the comparability of financial statements. In addition, cryptocurrency that are actively traded should be measured using fair value whenever reliable market prices are available. Using cryptocurrency prices fluctuate significantly, fair value measurement provides more relevant and up-to-date information than the historical cost approach, allowing financial statements to better reflect the actual economic value of these digital assets. The next recommendation focuses on companies and professional accountants. Companies should enhance their financial disclosures by providing more comprehensive information about their cryptocurrency activities. This includes the accounting policies applied, valuation method, purpose of holding crypto assets, market risk, and the cybersecurity measures used to safeguard digital assets. More transparent disclosure will enable investors and other stakeholders to better understand the company's exposure to cryptocurrency and make more informed decisions. Furthermore, companies should strengthen their internal control system by implementing secure digital wallets, multi-signature authentication, segregation of duties, and regular reconciliation of blockchain transactions. These controls help minimize operational risks, prevent fraud, and improve accountability over cryptocurrency assets. Finally, professional accountants and auditors should continuously enhance their knowledge and technical competency in blockchain technology, cryptocurrency accounting, and digital asset auditing through continuing professional development programs organized by the Malaysian Institute of Accountants. As cryptocurrency continues to evolve, accounting professionals must remain equipped with the necessary expertise to apply MFRS consistently and exercise sound professional judgment. Overall, this recommendation directly addressed the classification uncertainty, valuation challenges, disclosure gaps, and audit issues discussed earlier. By implementing this improvement, Malaysia can enhance the transparency, comparability, and reliability of cryptocurrency financial reporting while strengthening investor confidence in the rapidly growing digital asset market. These recommendations not only address the current weakness in cryptocurrency accounting, but also help ensure that financial reporting remains transparent, consistent, and relevant as digital assets become increasingly important in today's economy.
And cryptocurrencies are transforming the financial reporting environment and challenging the traditional accounting framework. Although existing IFRS and MFRS standards provide temporary guidance through IAS 38 and IAS 2, many researchers believe these standards do not fully reflect the economic characteristics of cryptocurrency. As digital assets continue to become more widely adopted, accounting standard setters will need to develop more comprehensive guidance to improve transparency, comparability, and investor confidence. As future accountants, we must also continuously update our knowledge of emerging technologies, digital finance, and evolving accounting standards. Technical accounting knowledge alone will no longer be sufficient. We will also need analytical thinking, professional judgment, adaptability, and digital literacy to meet the changing demands of the profession.